encourage you in a couple of ways. One is, again, I applaud your presence here because what it says, it speaks volumes. It speaks to your commitment to want to perhaps take that next step. And it is very much in line with what we believe here at our church. And so we were very, very happy to partner with Sister Tanya Powell-May in this effort, as well as Sister Coleman and Sister Nichols. And so we are super excited to host this. Our plan is to perhaps do more of this to provide this opportunity to community. And what I would like to offer to each and every one of you is if, as you go through this process, if you endeavor to own a home, and when that happens, if you could let us know somehow, some way, because we would love to buy you a housewarming gift. Amen. I mean that. So let us know, please do. And we would love to come and do that because, again, we are just super excited that you're taking the time on this morning. This is good information for you to take in, and our hope is that you will benefit from it immensely. So again, thank you for this opportunity, and have a great session. Thank you.
Thank you, Pastor Jones. We appreciate you allowing us to come today to share information. So all of you have made the bold step to say yes to a better financial future. I am Tanya Powell-May. I'm one of the presenters. We welcome you here today again, and we want to just say thank you for taking the time. We are prayerful that what you walk away with will help you on your journey, whatever that goal is, to have a better credit score, to buy a home, to whatever your dreams, to start a business. We want to pour into you, and hopefully you all walk away with the information that you came for. So first, I'd like to recognize a couple of sponsors before we start on the program. I would like to recognize the Realtors of West Michigan Association. The president of that organization is Jay Kilgo. He's here with us today. If you can come up, Jay, and just say a couple of words.
God bless you all for being here this afternoon or this morning. I'd like to thank Pastor Jones for giving us the space, and to all of our speakers today. My name is Jay Kilgo. I'm an associate broker for Pinnacle Realty West. I'm also the president of ROMA, the Realtors of West Michigan Association. We're a newer organization, but we are the first West Michigan chapter for NAREB. NAREB is the National Association of Real Estate Brokers. It is the premier Black real estate network across the country. And we've had a chapter for the last 75 years in Detroit, but we now have a chapter here in Grand Rapids. So we are just looking to do things for our community, to build our community. Our focus is democracy and housing, and educating our people on how we can have more homeowners here in West Michigan. So I'm always reachable. I work very closely with Tanya with 1,000 Families of Color. And if anyone ever needs anything, or we work very closely with the Fair Housing Department too, because we know that there are discrepancies in treatment in what we see and what some of our counterparts see when it comes to the home ownership process. So we're just continuing to build so we can have equality in home ownership. So I'm looking forward to hearing the ladies speak today. Thank you very much.
Thank you, Jay. The next organization I want to recognize is 1,000 Families of Color. That is a newer nonprofit here to West Michigan. I serve as the executive director. Paula Woods, who's here with us, serves as a program manager. Our endeavors revolve around these three pillars. They're wealth building and financial literacy, and that's part of what we're doing here today. Home ownership, we're tackling that pillar here today, as well as getting people introduced to real estate and real estate related careers. We need more diverse representation within the real estate field, as well as in banking and title, as appraisers. We need more diversity in those fields. And as 1,000 Families of Color, we're trying to promote that, as well as to help 1,000 families, first-time home buyers, low to moderate income homeowners, to become homeowners in over the next few years. So again, my name is Tanya Powell-May. I want to start with a word of prayer. If you could pray with me. Heavenly Father, we come to you today just thanking you for this opportunity to deliver information to the community. Lord, you've given each of us a purpose and a passion for helping people to understand who you are and how great you are, as well as to recognize the gifts that they have and the talents that they have, and to inherit the land. Lord, we trust you and we believe in you, and we want to touch each and every person that's here with us today and who's watching online, who has a desire to have a better financial future for their family, for their children, and their children's children. We honor you today. We give you all praise and all glory. And we ask you to bless the presenters, guide their words, give them the information that you would have them to share with your people today. In Jesus' name we pray these things. So before I hand it over to Tiffany Coleman, who's going to talk to us about credit, I'm going to give you some scriptural scriptural verses about wealth and finance that you should be aware of, because some people just don't have perspective about what we're supposed to have as for those of us who are believers. So I'm going to read Proverbs 10:15 that says, "The blessings of the Lord brings wealth, and he adds no trouble to it." Then 2 Chronicles 1:11-12 says, "Because your greatest desire is to help your people, and you didn't ask for wealth, riches, or fame, or even the death of your enemies or a long life, but rather you asked for wisdom and knowledge to properly govern my people, I will certainly give you the wisdom and the knowledge you requested, but I will also give you wealth, riches, and fame, such as no other king has had before, and you will ever have in the future." So that's a couple verses on wealth. "Also, when the Lord your God blesses you as he promised you, then you shall lend to many nations, but you shall not borrow, and you shall rule over many nations, but they will not rule over you. There's danger in putting security in a stranger's debt. It's safer not to guarantee another person's debt. Commit to the Lord whatever you do, and your plans will succeed. Now to him, by in the consequence of his actions, his power that works within him, he's able to carry it out and do exceedingly and abundantly above all we can ask or think." I'm gonna go back to this one. "Commit to the Lord whatever you do, and your plans will succeed." Another one, the last one that I wanted to share. Through skillful and godly wisdom is a house, a life, a home, a family built, and by understanding is it established, and by knowledge shall its chambers be filled with all precious and pleasant riches. So I just wanted to give some scriptural context to what we're doing today, because I am a person of faith, and I just believe that this process is not easy, and trusting in God to help you through and navigating the path is also something that will lead to your success. So the first presenter I want to bring up is Ms. Tiffany Coleman from TLC Consulting Services, and she's going to talk to us about credit. In each of your packets, there are 3 note cards. Feel free to write your questions down, and then after her presentation, we will be able to bring up all the questions and have her answer those questions. You don't have to put your name on it. That's a way to make sure that all questions are answered. There's no such thing as a silly question. There's no judgment. We want to know who sent up the questions. We just want you to ask questions, because if you're thinking about it, somebody else is probably thinking about it. So definitely use those note cards in your notebook. Everybody has a pen, correct? Okay. To write your questions, and then we'll have you ask Tiffany questions after her presentation. And we're scheduled for 11 to 2, but if we finish early, we're not trying to hold you hostage for sure, but we want to make sure that every question that you have gets answered today. So I will introduce and bring up Ms. Tiffany Coleman.
All right, good morning, everyone. My name is Tiffany Coleman, and I'm the owner of TLC Credit Counseling Services. So many of you are here because you are either in the home buying process or just thinking about it. So I'm going to go ahead and get started. And one of the reasons that what I'm doing is kind of giving you a outline of my credit ebook that is. Oh, I'm sorry. What am I doing? Is trying to give you an outline of my book that I created. I created this book because I noticed that many of my clients did not know what credit was for real. They were kind of just going out and applying for things, racking up inquiries, but had no clue what credit was. So, like I said, this is an outline. So I'm going to be reading from that. And I'm going to be asking you some questions too in the presentation. And I have a paper copy of my book. And if you guys know the question, I'm going to give you that copy. I'm going to give you that copy. All right, so let's get started. So some financial topics can be difficult to understand, but your credit score doesn't have to be. If you have credit, such as credit cards or loans for any purpose, you have credit history. And therefore, a report on your financial behavior and how you manage your money, your credit information is analyzed to calculate your credit score. It's a 3-digit number that, along with your credit report, is used for lenders to decide whether or not to grant you credit. In this guide, we'll look on how to repair your credit and how to get over 800 credit score. So many of you, I've noticed too with my clients that everybody was using Credit Karma. So I don't know if many of you use that, but that is not an accurate source for your credit score. You need to be using something that produces a FICO score. Okay, so that you can have you'll get excited thinking that Credit Karma is giving you an accurate score. You thinking you're at a 700, but you're really at a 580. So, so what is a score? A score is a number between 300 and 850. It tells lenders how likely you are to pay back the money you borrow, but it's not just used in lending money. In the United States, several lenders use credit scores to make decisions in deciding whether or not to rent you a home. A landlord considers your credit score. Cell phone providers also consider it when opening new accounts. If you want to buy a home someday, your credit score can determine how much the bank will lend you and what the terms of mortgage will be, including the interest rate. Companies may even check your credit score when you apply for a job or insurance policy. So that can be a soft pull too. So it may not be a hard inquiry, but it may be a soft pull, but they're going to check. So how credit works. A credit score can significantly affect your financial life. It plays a key role in lenders' decision to offer you credit. People with credit scores below 640, for example, are generally considered high-risk borrowers. Lenders often charge interest on subprime mortgages at a higher rate than a conventional mortgage to compensate for taking on more risk. They may also require a shorter payment term or a co-signer for borrowers with low credit scores. I forgot to do that. I'm sorry if you guys weren't able to follow along. All right. So conversely, a credit score of 700 or higher is generally considered good and may result in borrower receiving a lower interest rate, resulting in paying less money and interest over the life of the loan. Scores above 800 are considered excellent. While each lender defines its own credit score ranges, the average FICO score range is often used. So excellent credit is from 800 to 850. Very good credit is 740 to 799. Good is 670 to 739. Fair is 580 to 669, and poor is 300 to 579. And I noticed a lot of my clients had poor scores. So that just means that they were not educated in financial literacy at all. So we want to kind of bridge that gap, and I think that this seminar will do that if you guys follow along with what we're saying. Okay. Your credit score is a statistical analyst of your creditworthiness. Directly affects how much or how little you may be able to pay for the lines of credit you obtain. A person's credit score can also determine the amount of an initial deposit required to a smartphone, a cable service, or utilities, or to rent an apartment. And lenders frequently review borrowers' scores, especially when deciding whether to change an interest rate or credit limit or on a credit card. So if your credit score drop, your lenders could possibly change your limit. So just be aware of that. They do soft pulls all the time, and that can be a factor. Uh-oh. So the 5 components of your credit score. Your credit score is based on the following 5 factors. Your payment history accounts for 35% of your score. This shows whether you make payments on time, how often you miss payments, how many days after the due date you pay your bills, and when payments were last missed. The higher the proportion of on-time payments, the higher your score each time you miss a payment is. It affects your score negatively. So honestly, when I show you the profile, when you think about late payments, sometimes people will be like, I'm just gonna pay a little here, a little there. But when you miss a payment, that affects your credit score tremendously. So one missed payment can take your credit score down 50 points. So you really want to stay on top of that. Your profile really should look like for your for late payments should be anywhere between 99 to 100%. 98% is like no good in some lenders' eyes. So the amount you owe, loans and credit cards up to 30% of your score, makes up 30% of your score. This is based on the total amount you owe, the number and types of accounts you have, and the ratio of money owed compared to the amount of credit you have available. High balances and maxed out credit cards will lower your credit score, but lower balances can raise it. If you pay on time, new loans with a short payment history may lower your score temporarily, but loans that are closer to payoff may increase your credit score because they show a successful payment history. So the age of your credit history accounts for 15% of your score. The on-time history, I'm sorry, go back. So the older your on-time payment history is, the higher your score will be. It may seem wise to avoid applying for credit and having debt, but this can actually hurt your credit score if lenders don't have any credit history to examine. The types of credit you have make up 10% of your score. Having a mix of accounts, including installment loans, mortgage loans, and retail, and also credit cards, could improve your score. See, recent credit activity makes up 10%. If you have opened many accounts recently or have requested accounts to be open, this suggests a possible financial problem and may lower your score. However, if you have had the same loans and credit cards for an extended period of time and pay them on time, even after having payment problems, your score will increase over time. So this is a representation of what makes up your credit score. So 35% is payment history, 30% is amount owed, 15% is length of your credit history, and 10% is types of credit. The other 10% is new credit. So this is what I mean by the your credit profile. I don't know if you guys know how to access this, but like I was saying, Credit Karma is where you can get this so that you'll actually know what your credit profile looks like. Many people do not know this because you don't know where to access it. So this is mine. My payment history is at 100%. It was not always like that. With college loans, student loans. So I actually got those late payments removed because that's what I do. And my credit usage is at 6%. Typically, you will hear that you should keep your credit usage at 30%, but you really want it to be lower than that. 30% keeps you stagnant. You want it to be under 10%. And if you want to have just excellent credit usage, you want to keep it between 1% and 6%. The next one is derogatory marks, which means you either have judgments, you either have collections, or some other things on your credit report, and you want to keep that as 0 as well, because lenders are looking at your derogatory marks. The credit age, mine is a little bit lower because I just recently got a new credit card, but you want that to be at 5 years and 8 months or higher. Total accounts, you want to have at least 10. But if you can't, do your best to get to 10. And that will include like having even if you do like a short-term loan or something like that, they have a firm now, so you can do that. That can be added to your credit history if you don't have anything. And also cars, installment loans are included in that as well, credit cards. And also hard inquiries. So hard inquiries, this is one that you want to keep between 1 and 2. You don't want to just blindly go and apply for credit, because when you do, you look thirsty for credit. And lenders don't like to see that. So again, you can get this profile. If you don't know where to get it, you can get that from Credit Karma. So you should be looking at that. All right, how can I view my credit report? All right, so U.S. federal law gives you the right to receive a free copy of your credit report from each of the 3 major credit reporting companies once a year at the annualcreditreport.com or by calling 877-322-8228. You will not be able to obtain a free credit score this way. However, many banks and credit card companies now offer scores to their customers at no cost. Otherwise, you can purchase your score at annualreport.com, annualcreditreport.com, myfico.com, or you can also get off Experian. A lot of my clients use Experian. So beware of free credit score offers. Many sign you up for a monthly credit monitoring service and charge you fees. What if my credit score is low or I have no credit score? The credit scoring system is by no means perfect. Your payment history is the most important factor in your credit score. But what if you have never had a loan before? Students and immigrants to the United States often have low credit scores or none at all. Victims of identity theft may have had their credit scores damaged, and if you've ever had trouble paying your debts, your score may not be ideal. But fear not, by taking the steps, anyone can build it and improve their credit score. So what do you need to do to build your credit history or repair it if it's not good? Build a credit score or repair it. Fortunately, there are several well-proven measures for building a good credit score. The key is to report as much positive information as possible to credit reporting companies. These measures generally fall into 3 categories. 1, obtaining small credit accounts such as credit cards and paying them off responsibly. 2, reporting recurring payments that are not loans to the credit reporting companies. 3, correcting errors or defects in your credit report. Responsible use of credit accounts. A way to build credit is to use your credit card and pay off the balance each month. Of course, failure to pay on time can cause problems. So it is important to use credit responsibly. The amount of credit limit you are granted is determined by the credit score. If you have no credit score, you may not qualify for regular credit cards. In such case, some banks offer what is called a secure credit card. Secure credit cards are also an ideal way to build a credit history. So do you guys know what those are? Secure cards? Anybody has a secure card or ever got one? Okay. So those, when you do secure cards, you put a certain amount on that card, and if you pay responsibly and keep your credit limit low, your credit usage low, then typically what happens is after 6 months or however long the credit company you went through will give you your money back. So it's a deposit on building your credit. All right. So in fact, they are just what is that? Oh, okay. So in fact, they are just as effective as regular unsecured credit cards. Secure cards are different because they require the bank to hold cash security deposits, like I just mentioned, and in case you default on the debt. Over time, if you use a credit card responsibly and pay your bills before the due date passes, the bank will usually return the deposit and issue you an unsecured credit card. Another strategy is to become an authorized user on someone else's credit card account. I don't really recommend that. I have noticed lately that those can have an adverse effect now. They used to work, but now sometimes if the person is, say they have a $10,000 credit limit and the person is maxing that out, guess what? Now your credit score is going to decrease because of that. So if you're going to do an authorized user, be an authorized user on someone's credit, you definitely want to make sure that they are using their credit responsibly. So there are no requirements to qualify as an authorized user, and you will be able to build credit history with each timely monthly payment, as long as the company reports authorized users' activity to credit reporting companies. Local banks and credit unions may not. Also, your credit will be affected if the account owner pays late and does not pay. So I just mentioned that. So you really want to be careful with that. It can also be helpful to get someone to sign on, someone who can sign on an account for you, but be aware that if you miss payments, you can damage that person's credit. In addition to credit cards, other loans can also help you improve your credit score. Consumer loans to purchase, for example, appliances or air conditioners, are also useful. There are also credit builder loans offered by some credit unions and alternative financial institutions such as Missions Asset Fund. These are small short-term loans with low interest rates provided primarily to build credit history. So moving on to number 2, report regular payments that are not loans. Almost everyone pays monthly bills, but often regular payments are not reported to credit reporting companies. If you rent your house or apartment, you may be able to report rental payments to credit reporting companies through new online services such as renttrack.com. There's a small fee, but it's sometimes paid by the homeowner. 3, paying past due accounts or correcting inaccurate information on your credit report. Repairing or damaged credit history is difficult than building it from scratch, but it can have a big impact. First, the report should be examined to determine if it contains errors. If you find any, you should promptly dispute it with the lender or collector who reported the inaccurate information. U.S. law requires that those who report consumer information to credit reporting companies must respond and substantiate what they claim. So if they don't respond, you can have them remove that. They have to respond. So second, if you find negative marks on your credit report for unpaid debts or accounts that you have been passed on to collectors, you may benefit from a technique called pay to delete. So I will say sometimes people will take the road to actually just pay the debt, which is not a good thing. You actually have to make an agreement with them. Do not pay anything unless you have something in writing stating, it has to be in letter form or email, stating that they are willing to pay, for you to pay the debt, and they will delete it off your account. Because often what happens is that people will pay those debts and they will still remain. So it does nothing for your credit report or your credit score. So make sure you have that in writing. If the creditor does not agree to remove their information from the credit report, the only way the negative information will be removed will be when it is deleted from your report, usually within 7 years. However, in the last 12 months of payment history that carries the greatest weight on your credit score. Therefore, derogatory or negative information will have less influence on your credit score when time passes. Building your credit history can be time consuming, but with little patience and consideration, you can do it. So common sense can help you build your credit history. Creditors want your history to show that you also pay bills on time. So the key to a solid credit history is to pay your required installments on time. 5 ways to manage your credit to your advantage. 1, make a budget and follow it. To improve the management of your personal finances, it is not only enough to identify what your income and expenses are, it is also important that you follow your financial goals and set yourself in a disciplined manner. To the extent that you make financial planning and behave according to your plans, you will avoid surprises and successfully meet your goals. 2, responsible consumption. When acquiring a financial product, do not forget to inform yourself about the characteristics and benefits. Compare with other entities that choose one that best fits your pocket. 3, check your documents. Before signing the legal papers of your credit, loan, or credit card, make sure you are fully informed about all the clauses of your contract. 4, measure your ability to pay. Do not exceed the amounts of you request from your financial institution. Think that in the future you will have to pay back those resources, and it is important to adjust this to what your income allows you to pay. 5, be cautious when agreeing to a cosigner. Be very careful when cosigning or backing the debt of a third party. Remember that you are the one who has the obligation to cancel the debt in case the holder is unable to make the payments. Evaluate the risks before making decisions. So here's some recommendations for good use of credit cards. It is advisable to set a due date that is close to or after your salary payment date. Organize expenses and control payments through the credit card statement. Try to contribute more than minimum payment on the date indicated on the last statement. Credit cards can be used as collateral for airline tickets, car rental aboard, a hotel room reservations if you are traveling aboard. Make the foreign travel notifications so that the bank can monitor the credit card transactions. In case of traveling aboard, the cards are widely accepted in thousands of stores and businesses around the world, which is why it's convenient to carry one in case cash is insufficient. I did want to say something before I move on to this one. So some people don't know it's 2 different dates that are important when you have credit cards. One is the statement date and one is the due date. You want to make sure that you are at least making some kind of payment by that due date, because by the statement date, it will report whatever your usage is. So make sure you pay, if you can, do 2 payments. Payment on the due date and payment by the statement date, so that it will report a lower usage on your credit card. Like I said, it's important to try to keep that under 10%. So pay off credit card debts. Although it is said you should keep your utilization below 30%, the ultimate goal is to keep it below 10%. This will help you increase your scores faster, along with being eligible for more credit limit increases. This is important because the more that you keep your credit limit increases, your credit limits, your credit usage down, the more that the banks will be willing to increase your credit limits. You don't want to have $500 credit cards. You don't want to have $1,000 credit cards. The goal is to have higher credit limits. So you want to make sure that you keep those limits, the spending down, so that you can get those increases. And also have cards that actually give you something back. You want cashback cards. You don't want a card that's not benefiting you, because otherwise there's really no point of having it. Make all payments on time. Payment history makes up about 35% of your credit score, so late payments will have a negative effect on your credit score. On the contrary, paying on time is the best thing you can do to keep raising your credit score to the excellent category. Want to make sure you never miss a payment? Sign up for automatic payments on your credit cards and loans. So I recommend this to all my clients. I have them do auto pay so that you don't miss payments, because it's so easy to do. You can be busy and just totally forget about the date. So make sure you set up auto pay. Don't close old accounts. Closing an old credit card account because you never use it may seem logical. However, not keeping that account open can work against you. If you're trying to improve your credit score in general, it's best to keep unused credit card accounts open according to Experian. This is because the length of credit history makes up 15% of your credit score. Therefore, if you keep old accounts open, your score benefits from a longer average credit history. Another advantage is the credit limit on the unused credit card gives you a larger amount of available credit, which can help keep your credit utilization rate low. So don't go overboard with new credit card applications. I find that many of my clients decide to, once their credit scores start going up, just applying wildly for credit, which is a big no-no, especially if you're in the home buying process. You don't want to do that. Even if your credit is already good enough to be approved for many credit cards, don't go crazy applying for as many as you can. When you open several new accounts in a short period of time, creditors and credit reporting agencies may view it as higher risk credit, and it can lower your credit score slightly. Instead of opening new credit card accounts, work on paying down the balances on the credit cards that you already have. As your credit utilization rate decreases, your credit will likely improve as long as your payment history and other important factors on your credit report is in good shape. So thank you all. My name is Tiffany Coleman again, and here's my contact information. I also have business cards as well for you all, so I'll give you all that, and those are my social media pages that you guys can follow me on if you want to. Thank you.
So raise your hand if you have a card or a question on it.
You do? Okay. Yeah, you can call me. Yeah, you can call me. Well, is a debit credit card reporting? I don't think it is. Even though it's a debit card and it says Visa is not reporting on your credit report. So you should use your credit cards. I I actually recommend, this is me, and I think this is good for everybody, that you actually, if you have credit cards with high limits, use them every day. Make them your everyday cards, but make sure that you're able to afford what you're putting on those cards because it's an advantage for you. Using your debit card does nothing for you. Yeah, it's not reporting though. Nope. Yeah, it's not reporting at all.
So let's hear some of the questions, because this is usually the biggest obstacle for people when they want to buy a home. Let's hear some of the
Someone online had a question. I just want to read it. They said, should we have our closed accounts removed off our credit report?
Well, I know Stacy is going to touch on this too. I guess it depends on if you're in the home buying process. But for the most part, if you're not, you want to keep them on because it just builds your history, your credit history. So keep them on. Yes, sir.
So the balance between utilization of the credit card and balance should, and I guess you kind of already answered this with that, but like somebody got a new credit card.
Hmm.
Should they use it one time, pay that off, and then just leave it alone so they have that open credit? Or use it, continue to use it? If I have $50, instead of using my debit card, I use my credit card, buy something for $50 and pay it off before the end of the month. Is that a better way to utilize the credit card? Like using it, you know you have the money, and then just pay off
Yes.
your point that you use it?
Yes.
Leave it at zero.
You don't want to do that because what happens is if you're not utilizing, why are they offering you credit? So you need to constantly use it. So what I recommend, even if you're not a heavy credit card user, you need to easily at least use it every 3 months. Otherwise, they're either close their account or they're going to decrease your credit limit. So you have to use that credit card. You can't just let it go dormant because there's no reason for them to give you the loan. Yes, ma'am. Now that's something that Stacy can answer for you because some programs may have you may be able to do that. I'm not sure, but you'll have to ask Stacy that one. Oh, yes. So that's a service that I provide. Like I said, I also have another program too, and it's called Financially Lit Kids. So I discussed that in my story. Jake and was at the pitch that I did. But for me, I started off great. Like my mom started me off with 800 credit score. She gave me credit cards and all that. But listen, I didn't know what to do with that. I had high limit $10,000 credit cards as a college student. She didn't educate me though, so I kind of messed that up. And I had to go from having 800 to 540, and I had to pick myself all the way back up, and I had to educate myself. And that's what got me interested in doing what I'm doing today, because I noticed that we were lacking in that area. So I went from had the 540 up into a 770 in a year. So um that can be done. So late payments, I had those student loans because I wasn't paying on them. I'm like, I got all day to pay on those, all 30 years or whatever. So I just stopped paying them, and that took my credit score down tremendously as well. So what I did was I just I got them removed. I wrote those letters and stayed consistent and got those removed, and that jumped my payment history from 98% to 100%. So it's possible, but I will say that you can't have 100 late payments and think they're gonna grant you forgiveness to remove those. That's just not gonna happen. They may, if you have 2 or 3, they will do that, but if you have a ton, it's harder to get those removed. That makes my job really hard to fight with them back and forth to get those removed. Because how can I explain why you're constantly late on everything? So, but they can be removed. as well as inquiries and collections, all that, all those things can be removed. So I am the person to see if you guys need help with that. Any more questions? Oh. Yeah, I do, because I want you to. So I did ask a question about where can you find your credit profile, and if somebody can answer that, then I'll give you the book. Oh, she said it first. Here you go. Credit Karma. There you go. So I really suggest you guys look that up. Because otherwise you're kind of blind. You don't know what your credit profile looks like. That's the only way you can really see it. I don't know if anybody else knows any other way, but that's the only way that I found that you can see your actual credit profile and gives you the exact numbers and where your percentages are. So, and yes. So you have an open line that you're not utilizing. Well, if they're keeping it open, I guess it's a good thing because yeah. Yeah, so as long as they're keeping it open, it's fine. I mean, because if they feel like you're not utilizing, they'll just close it. So if they're keeping it open, it's fine. Yep. Yeah, they want you to use it. Because if they're being nice, especially if you only use it once every 3 years, they want you to use it. So just use it. Yes, ma'am. That's probably what's keeping it open then. Yeah, because it adds to your amount of credit. So it serves purpose.
It's not hurting your credit by having that open and not using it like a home equity line of credit. It's just the credit card is what she's talking about because if you're not using your credit cards.
Yeah. Yeah, I suggest that. I don't suggest you let any credit card lay dormant because they're going to take it from you. You don't want that. It's going to decrease your credit limit overall. Any?
Did you ask one?
So you're saying her just close that and use the credit card?
Her interest rate on the home equity line of credit is a lot lower than a credit card. So I want to.
Yeah.
Other questions? Can we hear one of those many questions that you have? Because I'm sure somebody online has to say.
I hear about the inquiry removal process, and some people's process it only be off for a little amount of time, and you got some people who do it and it stays off. I was hearing a couple of horror stories from different people on there, so I was wondering, is your process that you use to get the hard entries off, they stay off?
Yes, that's kind of different. I never heard of them being put back on. You sure that's not collections? It was hard inquiries? Really? Usually with the hard inquiries, it depends on what process they use. Maybe they're calling in and using like the identity theft method. So if they're doing that, maybe not. If they're finding that there's no identity theft required, saying that somebody's applied for all this different credit in their names, that could be why. But I use a letter process, so I don't call in. So I have paper trails for everything. I don't do anything. Oh, one thing I will say before I know a lot of people dispute online. Don't do that. You want a paper trail. So make sure that you are doing that. So whatever you're disputing online, that can possibly come back because, yeah, or you'll get a lot of denials because paper trail is just the best way to do it. Okay, so it depends. Sometimes you can do it within 7 days. Times it's 30 days. It just depends on how fast they respond to it. So it depends, like what you're trying to do. So if you have a ton of things on your credit, I will do a per fee per like $10 an inquiry or something like that. But if you want to do the program, it's $99 a month, and that removes late payments, collections, inquiries, and all that. And the process can take anywhere from, some people I've had, I can clean it up in 3 months. Sometimes it's 6 months, sometimes 9 or 12, but it just depends on you. So this is like a team effort. It's not just me. You have to be following up with me. And if I'm calling saying, hey, I need this from you, you have to respond so I can get things in a timely manner. But yeah, so that can be a fee per deletes basis if you needed that. But if you have a ton of them, I suggest you just do the $99 because that'll add up. Yes.
So that's not a big driver in terms of what you store in. The most important things, like she said, is your payment history, paying on time, right? So you want to have on-time payment, and you want to have length of history.
Yes, credit. Yes, you want to have the second one is the credit utilization. Yes, length of history. Yeah, those are the ones that make up the most of it. The inquiries is a small portion of it, but you don't want to have a ton of them. It's only 10%, but you really want to stay under like less than 3. If you have 20, 30, yeah, that's gonna look thirsty. You don't want to be thirsty for credit. It doesn't look good. Yes. Right. Nope. Exactly. Like I said, I've been there. So it's no shame because a lot of times, like I said, we were not educated. How can you know what to do with your credit if you were never taught anything about it? So don't be shamed. I got clients that have 400s. I got clients that have 600s. Wherever you start, just start. Just do it because it's very important to have your credit in a good space. You can't really do anything without credit. You got to rent. You got to have cell phone. Whatever that may look like, you're going to have credit. So yes, I forgot about that. Yes. Yes, you will pay tremendously. You would pay tremendously. I recently just purchased a new truck, and I was looking at the rate. So if you like, say, if I didn't have my 770, and I went in with a 680, not 680, 620, I would have been paying like $800 a month. That's tight, right? You don't want to do that. So it's important to fix your credit. Take baby steps, but get it done. So it's definitely going to hurt you in the long run financially. You're going to pay more money. Any more questions? Nope. All right. Well, thank you all.
So I want to bring Staci up, and I think Dale mentioned the restrooms are out until the last one. We need to go to the restroom, feel free to get up, come back anytime. But next we will hear from Staci Nichols. She's a mortgage lender from Mercantile Bank, and she will talk to us about the mortgage process and what to expect from that.
Good morning, everyone, or good afternoon, everyone. Thank you, Pastor Joe Jones and Miss Jessie Jones, for allowing us in your space today. Thank you, Tanya, for the invite to be a part of this event. And thank you, Tiffany, for your presentation. Thank you all for being here and taking this first step, or a continued step, it may be, on the journey to home ownership. Two things I want to lift up from Tiffany's presentation that are very important to the mortgage process. One, paper trail. I will touch on that and the importance of that. And then also the concept, it left me. When I get to my one slide, credit is so important. You cannot talk about home ownership, but I will come back because there is something else that I want to lift up. But the theme for today, paper trail, paper trail, paper trail. In your packet, there is my PowerPoint presentation, and I am going to go through there. Feel free to write down questions as we go. If there is a burning question that you want to get out, raise your hand. I will acknowledge you. I am a loan officer with Mercantile Bank. I've been in the mortgage industry for the past 2 years. I've been in the financial industry I started over 20 years ago. I've served as a homebuyer educator, credit counselor. And one thing Tanya mentioned earlier is it's not easy, but I believe it is very necessary to change the trajectory of our community. I'm glad we're having these conversations more frequently. And as far as credit goes, I believe we should have this conversation much earlier, because there is knowledge and then there is behavior. So we are learning it. You must apply these behaviors over time to change what we have seen in our community as far as access and wealth building goals. And that's why I have a passion about educating people about how to gain mortgages, because home ownership is the cornerstone of building wealth in this country. So let's get started. Where do you go to get a mortgage? You can go to your bank. You can go to your credit union. You can go online and get a mortgage. There are mortgage brokers that are kind of like, wholesale shop. They may offer a different variety of products. I am at Mercantile Bank. You can come sit with me in person. There's ways to complete an application electronically. The point is, you have many ways to access a mortgage. Ideally, you would have spent time preparing, building credit. You can start from today and be at zero credit score and build history within 2 years, which is when I get to the income, which is the amount of time for the income we're going to verify. The point is, if you had never thought about this, you can take this education and become a homeowner in 2 years if you apply the knowledge. So you have options of where to get that mortgage. There are different kinds of mortgage products. There's a conventional mortgage, which is a privately backed and bonded mortgage. There's FHA, which stands for Federal Housing Administration. Those are government backed and bonded mortgages. There's rural development, that is RD, that is determined by the census tract, as set by USDA. You may hear these acronyms. I feel it's important to let people know, because the terminology can confuse people to the point where they're like, I don't even want to go any further. So USDA stands for U.S. Department of Agriculture, and they give rural development loans. VA stands for Veterans Administration, and those are mortgages that people that have served in our military can take advantage of. So all these are various mortgage products. So first-time home buyers can take advantage of any one of those and pair additional down payment programs or additional products with those loans. So you could get a conventional mortgage and use a down payment program together with that, same as FHA. If those the investor is what they're called, allows that with their program, you can use it. Once I have assessed the client, then I can determine what you qualify for. So as Tiffany said, everyone is different. Until you are assessed individually, we won't know what you may be able to do. Okay? Everyone's different. Everyone's work history, everyone's credit profile, everyone's income is different, but it's a good loan officer's job to assess you and give you all your options and support you on that journey. Rates and terms. Rates, there's a lot of conversation on the news. You may have friends and family. We know we're in what's called a more volatile market right now. Do I think that you should not try to prepare or even purchase in this market? No. Home buying does not cease in volatile markets. It slows down, but it's always a good idea to buy a home and have a mortgage. Question for everybody, show of hands. Who's paying a mortgage? Somebody, I see some hands that aren't down. You're paying your mortgage or you're paying someone else's mortgage. So that's perspective for you. And if that could be perspective, why not, even in a volatile market, prepare to pay your own mortgage? Because if you're paying rent, your landlord is benefiting that so they can pay their mortgage. Yes, it's a risk, but it's also a reward and a responsibility. As I said, to build wealth and to have equity. When we pay our rent, we don't see those funds. Again, when you pay on a mortgage, you build equity, and that home can become your very own bank to finance your future goals, to finance your children's college education. We'll talk about the impact of student loans. Maybe, that could come from the equity that you build over time in your home. You start now, your children are young, you're planning for their future and to set them up for success and build generational wealth, which again is one of the pillars here. And I know that is important to Tanya, Tiffany, and you in this room as well. So we talked about rate, again, is going to be individual to you. So I'm not going to dive into a rate conversation today. The term is just meaning the length of the mortgage. And there's a variety of terms that you could have. The typical term is 30 years. That's 360 months. You can also have a 20-year mortgage. You can also have a 15-year mortgage. You can refinance whatever mortgage you start with to something that's more advantageous. Sometimes we do what we got to do to get in the door, and then we set up a plan to adjust that in the future. Anything else I want to touch on? Anything that you do close as far as the rate and term is disclosed to you on paper and identified as fixed, meaning it cannot change unless you take an action to change it, or adjustable, meaning it could change, and those terms will be disclosed to you. So if you hear ARM, that stands for adjustable rate mortgage. An example could be for the first 5 years, you have a fixed rate, and for a period of time, say every 6 months following that, the rate could adjust based on the market. In this kind of volatile market, that could be scary for some folks because it's based on the market. And one thing I will, before I move on from this conversation, is let you know that the rate is set by the Federal Reserve. Various financial institutions have margins where they can make adjustments, but we don't initially set the rate. So this economic condition that we're in, everyone is feeling the impact, and it's affecting mortgage rates, auto loans, credit cards. Check your credit card statement when you get home and see if maybe last year you thought you were paying a certain rate. Just take a look and see if you haven't already done so what you're paying now, the cost to borrow money that we all pay. And just know that you have many options and you should learn them all and pick one that works best for you. So as it comes to home ownership, think about a few things. Your budget. What is going to work for your monthly budget? Home ownership is a big responsibility. In addition to the mortgage payment that you must make to the bank if you want to keep the home, there are maintenance fees, unexpected fees that as a renter, maybe you didn't know were responsibilities, but now as a homeowner, you are responsible for that roof. You are responsible for that furnace. In our Michigan winter, we can't have, no emergency fund. If the furnace goes out tomorrow, you must take action to get that corrected so your family can be safe and warm throughout the winter. So those are the different kind of things that you want to think about as you prepare for your journey. And if you do start the pre-qualification process, which I'll get into next, what you will be able to show. I'm going to answer your question that you asked. You asked can you get a mortgage zero at the closing table? So are you asking, can you not contribute any funds to a mortgage transaction? Okay, the answer is no. You will have to make an investment of some sort, and I will have to verify that before we even get into the transaction. Earnest money, which Tanya will probably touch on, is your initial investment that you make and give to your realtor as a show of good faith. So that's cash out of your pocket up front. It is deducted from your closing costs, but I have not seen a scenario where a borrower will have $0. there could be various programs that may advertise that, but you have to be aware that there's loan fees, there's escrow accounts, taxes and insurance that must be paid to third parties, the city, your insurance company. So I'm not aware that there will ever be a transaction where the borrower would contribute $0. So in speaking of the financial aspect, we are verifying the earnest money, and this is where the paper trail comes into play. We're going to assess what's necessary and where these down payment funds are coming from, and then the closing costs and prepaid items. So I spoke on the loan fees, the escrow account that pays the homeowner's insurance and taxes on your behalf, and then interest, prepaid interest before you make your first mortgage payment. So the day your loan closes, there is a balance of money that you're responsible for, and all of that is itemized for you. The paper trail, I can't express it enough how now as you're paying off credit, because you may do things to correct your credit in 3 months or whenever I get to your file, and I may have to have proof of that to make it count. If we can't show proof, then it doesn't count. Have you ever heard the saying, if it's not written down, it didn't happen? Think of that as it relates to the mortgage happen. If we can't prove it, I may not be able to use those funds. Okay. All right. Something else you want to think about is how much you want to spend for a down payment, which may affect which kind of mortgage program we use. The mortgage payment is going to include principal, interest, taxes, insurance, and more private mortgage insurance. You will have, we can do quotes similar to auto insurance for the mortgage insurance, but if you get an FHA loan, there's a premium that's set by the Federal Housing Administration that is a percentage of the loan amount. So you don't have an option there. If you get a conventional mortgage, we can look and see, are we going to pay the entire first year mortgage insurance up front to lower your payment, or are we using a down payment assistance program that also lowers that percentage that you pay for mortgage insurance? Just like your auto, the lender wants to be protected if something should happen. So you do have to pay that as a portion of your monthly payment. And then home maintenance, as I touched on again, that could mentally, that should be in, you may not see that on paper, but you want to save a portion for those unexpected things, or just for the cosmetic upgrades you want to do to your home to increase the value. Another thing to think about, are you purchasing your starter home or your mansion on the hill? This will speak to the amount of time that it takes to prepare for this. Do you want to just get into the home ownership game to stop paying rent, start building equity, and then in 5 years you'll plan for that dream home purchase? You have to kind of be honest with yourself about what it is you want, and then share that with your loan officer so we can work together to make a plan. As Tiffany said, it's a partnership. And because you're unique and there are many different options, it's best to be transparent about what you want. And the loan officer should be transparent about what's realistic. And if that's not right now and we're going to plan for it later, or you are in a position to have exactly what you want at the moment. All right. So the keys to loan approval. There are 4 legs of a table needed to get a loan approval. They are credit, as Tiffany touched on, income. You must be earning some type of income when you apply for a mortgage. The different kind of income could be your job. You could be a W-2 employee. You could be a business owner, be a self-employed borrower. You could get a mortgage with Social Security. Child support counts. You could receive a pension. The point is, you have to have some income at the time that you apply for the mortgage. Assets, funds for down closing, or for the down payment and closing costs. We verify that up front with your 2 most recent bank statements. In a mortgage transaction that you're borrowing funds in, cash is not king. So put the money in the bank if you are saving it elsewhere, because I'm going to collect the 2 statements prior, and then all the documentation has to be current in the file. So a mortgage transaction can have many unexpected things happen, because again, we're working with appraisal companies, title companies. There's the seller, there's the borrower. So because it's unexpected, if we have to collect documents, you want to show some consistency on paper. If you couldn't speak for yourself, you want your documentation to speak for you. You want consistency in your pay stubs. If you're working 40 hours a week and you tell me that, I need to see that on every pay stub. If I see 36 hours, I'm going to have to make an adjustment. You want to just think, if I am not saying anything, my documentation is consistent throughout. If you show me I have this amount of money in the bank, I want to see that or more. I don't want to see less, because then we're going to have to make adjustments. So again, paper trail. So for the borrower, credit, income, assets are the keys. And then once we have the house, you're under contract, then that collateral is assessed as well. And that has to be improved by the investor. If it's conventional, if it's FHA, these are different guidelines, and you will work with your realtor to make sure that those guidelines are met for a successful transaction. If not, in the underwriting process, we will find out the requirements. Can they be met? Or no, this transaction won't work, or this home is not eligible, and then we may have to make some adjustments. So I guess my takeaway that I would say is be willing to be flexible, because homeownership is such a lofty goal. You could have your heart set on something and only want to see one outcome, but you have to know that we may have to pivot, and you want to be flexible throughout that process until closing. All right, so documents needed. Your loan officer is going to ask for W-2 employees, your W-2s for the past 2 years. So it's December 2022. Right now, if you were to apply, I would need to see all W-2s from 2020 and 2021. In a couple of months, I'm going to start asking for W-2s from 2021 and 2022. So we're going to assess the income for the past 2 years. Test 1, 2. All right. Okay. So 2 most recent W-2s, 2 most recent pay stubs. And again, these will be recent to the file. So if you're out house hunting for a month, then I'm going to need more pay stubs. We got to keep everything in the file recent. 2 most recent bank statements. I suggest sharing all financial statements, and I see sometimes hesitancy to disclose to the loan officer all your assets. And I want to say it's better to overshare in this scenario, because the loan officer's job is to assess what we actually have, to give options. It doesn't mean if you show me all that you have, I'm going to make you spend all your money. But I would rather know what our options are and educate you on those than not have enough data, or have to struggle collecting documentation later in the process, and have to explain things to the underwriter. So share all the statements you have. You can use your funds in your savings or checking account. You can have a gift from a close family member. This is a parent or a child, your play cousin, or your second aunt twice removed may not count as someone if the relationship doesn't make sense as far as gift funds go. And we're going to verify their funds as well in their bank statement, and they have to have a letter stating that it is truly a gift. It is not expected to be repaid. Borrowing money for a mortgage is not a good idea. It's actually not I'm not going to say not acceptable, but it shows Tiffany used thirsty for credit. So if you are looking to borrow funds to buy a home, which is borrowing money for a 30-year mortgage, there's a mindset shift that needs to occur, because you have to make an investment into the transaction. You're asking a lender for funds to pay over 30 years. You could pay them back quicker, but you have to say, I'm good for this by putting your money into the transaction and then showing on paper the history, the credit history that we look at, the pay stubs and the bank statements. Angelique, did you have a question? No, there's no limit on how much can be gifted. Specific to the program and the client, there could be, but generally speaking, I would rather you present the documentation to me so we can get to those details if something is different for the client. Okay. So the documentation we were discussing, all other income statements, again, Social Security, disability, child support, pension, all those things can be used in a mortgage transaction. So if you are using that, I just need the current statement saying what those benefits may be. And also your valid driver's license or state ID, which has to be current, no expired IDs. Everyone needs an ID to apply for a mortgage. Yes, Jay? As far as gift funds or in general? Mm-hmm. Mm-hmm. No, I want to see the paper. That's the verification. So straight from the bank, I want to see the most recent bank statements. I can't take screenshots of these bank statements. I don't want a transaction history. I want the bank statements from the bank account to verify your funds. Can't come from underneath the mattress. It can, but after it's seasoned and it's set in the bank for 2 months, then it's verified funds. I have had scenarios where a memorable one, a young couple getting married, and they had a celebration over the weekend. And of course, their family gifted the money for the upcoming nuptials. And then you see this cash deposit. And what is this? You know, these are gifts from our friends. Well, we can't verify those funds. There's no paper trail. Unfortunately, it can't count. Now, you need a home inspection. Use the cash for your home inspection or something like that in the transaction that will benefit you. But if you throw some mattress money in the bank, I can't count that tomorrow. And I have that conversation often, and I can't reiterate enough. Paper trail, and put the money in the bank. The longer, the better, because it shows stability. This paper is speaking for you. It shows security. Any other questions around how we verify the funds and what counts and what doesn't count? Okay. So you want to organize your finances and your documents. You want to complete an application, an individual or joint application. If there are more than one borrower, everybody needs to be on the same application. If we're going to change, that's going to be a new application. For some instances, in some instances, someone will apply and then they'll say, okay, I want to add such and such. Okay, we have to do new application. Or some people will apply jointly, and then we may have to remove a borrower for whatever reason. That's another application as well. I'm going to do a plug here. We are doing a pre-qualification day in January. I find that it's better to pre-qualify or to apply and learn where you stand instead of I have a lot of hypothetical scenarios, and I truly need to see your income, your credit for sure, your assets to best advise. So a hard inquiry does impact your credit, as Tiffany stated, but for the purposes of obtaining a mortgage, you want to learn where you stand so you can specifically attack the things that need to be fixed. Because it is different from applying for a credit card or different from applying for an auto loan. A home is typically the largest purchase you will make, so those requirements are stricter, but it will be the most beneficial purchase you will make. So my suggestion as you do this credit work is prepare for a mortgage and then have fun with the credit. Because once you do have a mortgage on your credit, your score is going to impact in a different way. One thing you talked about is the types of accounts. So a mortgage is its own type of account on your credit. Then there's installment accounts and revolving accounts. So once you do successfully get the mortgage, your credit score is going to boost as a benefit of having that specific type of account. So my advice is build for your credit or for your mortgage purposes, and then you'll enjoy more benefits of all that hard work that you've built that credit for over time. Once you have completed the application and had your documentation assessed, then you will learn, if you're pre-qualified or pre-approved, those words are used interchangeably in the mortgage world. Typically, pre-qualification can be just you telling the loan officer those things, and the pre-approval is a verification of those things. But you want both. You want to give over the pay stubs, because if you're not salary and you're an hourly employee, we know that income fluctuates. So you may be calculating based off a 40-hour work week, but we may use 38 hours. And that makes a difference. So I suggest giving the documentation over and allowing the loan officer to scrutinize that documentation to give you the best information. People will just want to know details without providing any documentation, and that's understandable. But for the best information, you want to be very transparent and work with the loan officer to get the most accurate information. Once you are pre-approved, you will learn the details of your mortgage program. If you are doing an FHA mortgage, which at Mercantile Bank, the lowest credit score that we will do a mortgage at is 580. That is definitely going to be an FHA mortgage. I'm going to tell you about FHA specific programs. If you say I want a conventional mortgage, I'm going to say, okay, this is what we need to do to get you closer to the average number is 680. That's 100-point different. If you want that specific type of mortgage program. So I will say, this is what we can do. These are your options. Do you want to proceed, or do you want to make a plan and proceed later in the future? Nothing is final until you sign at the closing table. So that is kind of where it goes back to being flexible throughout the process. I think people think applying is committing, applying is learning, applying is planning, applying is preparing. But when you get to the closing table, which is the most exciting day, and you sign, that's when things become final. There's so many things that happen in between there, and a lot of education for the clients that can happen. So you might not get it all up front, but you will learn as you go through the process. And then once you have gotten your pre-approval letter, then you will go out and shop with your realtor to find the home that fits. Once a contract has been received on a home, then we come back to the processing and underwriting process. So in a mortgage process, there could be many underwriting processes. I do an automated underwriting up front to determine if we are pre-qualified to move forward. If we get an approval there, then you go shop. And for the people that get that initial approval, you shop, come back, it's underwritten again by my processors, a fact checking to make sure we can actually do this loan. And then once we assess you, your documentation, we call the job, the employer, hey, does such and such work here? This is their start date, end date. Yep. Okay. That's verified. The house, we're doing appraisal. The value meets the sale price. Okay, great. Then the underwriter again verifies and does a process for that. So throughout the process, you will go through multiple underwriting, and we have to just keep passing each one to get to the closing table. If there's a hiccup in the mix, we either have the opportunity to correct, or sometimes we may have to go back to the drawing board. Again, each situation is unique, so we don't know unless we go down that path. Hopefully we make it through all the underwriting processes and we get to the closing table, where you will sign and the ownership will change from the current, from the seller to the buyer's hands. Your responsibility after that is the housing payment, again, which I discussed. It includes the principal, which is the repayment of the balance of the loan only. the principal amount of money. There is another amount, there's another category of interest. Because this is such a long loan, initially you pay more interest up front. And you get what's called an amortization schedule at the closing table, and it will show you all 360 payments and how much goes to pay down the principal, how much is going to the interest, what your taxes and insurance are. The taxes are set by whatever city you live in. The insurance, you get to choose your home ownership insurance provider, so that will vary. And then the mortgage insurance we talked about. So you make one payment, and all those payments, all those 5 categories I talked about, get a little piece of that pie, if you will. The income needs to be stable throughout the process. Depending on what programs we use, and this is more specific to down payment programs, they have their own income limits, so you have to qualify for the mortgage as well as that program. Common down payment assistance programs are MSHDA, which stands for Michigan State Housing Development Authority. They set their credit score, which currently you must have a 640 middle score. Our credit pool is tri-merge, meaning it's coming from all 3 bureaus, and we just take the straight middle score. So if you're looking to use MSHDA with your mortgage product, you must have a 640 middle score. If you don't have that, it doesn't mean you can't get a mortgage, but you will not be able to use that program. The city of Grand Rapids also offers a down payment assistance program, and they have a little different rules than MSHDA may have. These programs set their own income limits to make sure that it's fair for borrowers. So you have to fall under the income limits as set by the program. So in those instances, we're qualifying both for the mortgage and for the down payment program. And if you're telling me I need down payment assistance, we have to make sure that you qualify that before we pre-approve you for the mortgage, because we will need that to close the mortgage. Credit, Tiffany did a great job. So the only things I want to add, DTI, how credit relates. And this can be confusing for borrowers. So DTI in the pre-qualification, that stands for debt to income ratio. So this means that a percentage of your monthly income is allowable for debt that reports to your credit and includes the new mortgage payment, and you must fall under a certain percentage to pre-qualify. A standard number, and again, this can vary, but a standard number is around 45%. That is also MSHDA's maximum for your debt to income ratio. So this means that your new mortgage payment plus any current credit obligations must fall underneath this. 100% of your income is not allowable for your mortgage, because that is not affordable. Car insurance doesn't report to credit. Daycare, which can be a huge expense, doesn't report to credit. Your food budget, which this is what we need to live, we don't know that. So you have to allow for other life expenses, because we don't want you to be what's called house poor, where you can only pay that payment and you can't live. Or in the case of home ownership, you can't afford to make repairs to keep the home in good condition, or you can't afford to do upgrades. So as far as the debt to income ratio goes, know that only a percentage of your income is in 45%. And you can take out your calculator now and if you make 5,000, do times 0.45, and whatever that number is, this is your new mortgage payment plus whatever you're paying now needs to fall under whatever is about 45% of your income. If you're over that number, you may have to get rid of some debt. This could be counterintuitive to what Tiffany told you, because she said, don't close the debt. But if your goal is to buy a home and you are already overextended on the debt, I may say you may need to get rid of some debt. And you have to pick the lesser of the two evils. If you want to get a home, we're not worried about impacting our credit score. We're going to meet this goal of home ownership, and we may have to get rid of some of that debt. Looks like there's a question.
So for instance, if I got a car 3 years ago when I had bad credit, but they gave me a car and my car note is $600 a month, you have refinanced some people's car notes or refinanced certain debts that people have to get their DTI under that 45% or at that 45%.
I may suggest that.
Is that some things that you've done before? So sometimes some of the higher bills like a car note,
Mhm.
and people don't think about that
Mhm.
when they want to get a house, but they have some debts that are higher. Some of those things can be consolidated or paid off
Absolutely.
to get to where they need to be for a house.
With the car note, that's a great example because a car is a necessity. And you can get a car with poor credit and have an extremely high interest rate. Some people could pay 25% or more. And if you don't look at that amortization schedule, or sometimes people don't even care, they just want the car. If you don't really know the true cost of that, it, for one, is hurting your pocket. And for two, if I look in the mortgage process and I see a $600 car note and we need to get rid of about $200 debt to qualify for the new mortgage payment, we may suggest that go refinance this car or eliminate some debt. Keep the documentation because I need a paper trail of what's happening here. Yes, it's going to impact your credit, but credit reports are good for 4 months or 100 days in the application. So I'm not going to see whatever impact happens, but I do need to know that that debt has been minimized or eliminated to meet the goal of home ownership. Credit counseling for home ownership is specific. Tiffany, some of your slides said in general, when you get to preparing for home ownership, it's specific to that goal. If you can get approved for a mortgage, you can probably get a car, a credit card, things like that. But if you get approved for a credit card, those requirements are different from the mortgage qualifications. Little quiz for you guys. The inquiry for your Macy's credit card at the store and the mortgage, how many people think that's the same kind of inquiry? How many people think that's a different kind of inquiry? It's the same. A hard inquiry is a hard inquiry. Suspended on the mortgage pre-qualification. Because again, if we can get you successful there, you know I can probably go get that as well. If your debt to income is in line, but if you're extended, then maybe not. Tiff?
I know we were having a side conversation too, and it's important to know, like when it comes to credit scores, that you know that you have more than 3. I don't know if many people know that you have like over 28 credit scores. You have the FICO 2, 3, 4, 5, you got 8, 9, and 10. 10 just rolled out. So just be aware that your credit scores may be different. So like Staci said, once they're in that process, not focus on that. So just, take care of the other things that you need to take care of. I've had a client that had to, when she was going through the process, they asked her, could she pay her car off? That could be a possibility. So just know that. Be looking out for those other credit scores as well. So don't, you have to find other sources where you can find those so you can know where you stand as well. Because you may think you have a 680 and then you go and check your FICO 2, it might be a 600. So. Yeah, the 3 ones that they use.
Yes. Do you have a specific credit question that you want me to address? Oh, yes. We do the tri-merge report pulling from Equifax, Experian, and TransUnion. Those scores could be different today than they are tomorrow. But when I pull, you could have just gotten a credit score from someplace else last week, and you come and tell me that score, but I may pull and see 3 different numbers, and then I'm just looking at whatever bureau has give me is the middle number, and then that one sets the tone for the application, determines the rate. Because you can't get an interest rate without having a credit score. That's how the interest rate is determined, by your credit score.
This is a lot of information.
It is.
And I was just self-taught. So all this stuff, I just did. However, I'm thinking, how are young people going to learn this? This really needs to be in all school systems. Even if they don't understand all at first, somebody's going to come back to them when they're getting ready to do this. But without this help, I'm thinking, I'm calling Tanya, or I'm going to direct them to. So it just seems to me that I can't see how a young person would get that point where they think they're ready to get a home and they have to go through all this. You know what? I'm just going to shrug my shoulders and say, give up. And so this is a lot. And I think that we got to do better in our schooling of our young, even when we get into the 12th grade, it's said, well, I'm going into work or I'm going to start with the college, but they need to get it soon so they can be ready, because by the time they think they're ready at age 30, 35, they don't have a clue. And this is a lot of information, good information, but an awful lot.
It is. It's overwhelming.
Yeah.
And I don't want anyone to believe that it's not, it's an easy process and that it is a lot of information. My mother always used to say repetition is learning, repetition is learning. So we do need to have these conversations more frequently. I am happy to see legislation that states financial literacy will be taught in high school, because what happens when the children walk out of high school, they're bombarded with credit card offers. And like Tiffany, I messed my credit up first and had to learn through the process of cleaning up. And then as I learned about mortgage, you have a thought of, okay, this is what I need with the credit. And then you learn it's specific to the mortgage process. So without being in this spaces and without people educating people, and repeatedly, you won't know. And then without you going on that journey yourself, because it's specific to you and that could be different for his journey. So it is important that young people have the education and that they have the discipline to apply it and then go through the process to learn what does my income, credit, and assets afford me at this time? Is it a 5-year plan? Whatever the case may be, to reach that so we can break some of these cycles.
And the first thing we talk about building wealth, and you said, well, home ownership is the cornerstone. I think someone made that statement, to building wealth. How are young people going to ever begin to understand how to build wealth? We talk about it a lot, and they say, okay, I can do this, but if this is this can be a vital part to it. This has to happen. This really has to happen, and the sooner we do this, the better. So
absolutely,
yeah,
as a community at large.
That's what I'm speaking
because
about.
Other communities are setting their children up much sooner.
That's what I'm talking about.
Unfortunately, our community, we kind of learn through the mistakes or going through the fire, and we have a responsibility and the opportunity to change that right here, right now.
Exactly. We have to do it, and in some families we do it, but it's gonna be more than just our families.
Absolutely.
I think I'm finished for now.
That's okay. I just wanted to mention that Tiffany has an excellent program. I did hear her pitch at the pitch competition, where she is specifically teaching young people credit and wealth management and stuff like that. So I hope I will continue to promote your product and your small business because it is excellent. And I did vote for you, but also our local Roma, our local NAREP chapter Roma, we are trying to work with school districts and school systems here in West Michigan to get into the classroom, to get in front of some of the young people, because you're right, it currently is not taught to our students and our youth where it should be and could be, and then they step out of high school, whether they go to trade school or college or just into the workforce, but they'll have some knowledge of credit and wealth building.
And imagine if they step out and say, I'm going to prepare for home ownership, and how that will change their future, the example they will set. There's a lot of things fighting for our young people's attention, and somehow we have to kind of, I believe it's related to the value you have as yourself. In yourself, it will translate to your finances, and it will translate to the behaviors of these wealth building activities. And this is not an instant gratification process. This is a delayed gratification process. And we have to kind of reprogram, and it's a psychological concept. That's another conversation for another day. I'm going to touch on 2 more things for credit, and then I'll move on here. Student loans, hot topic of conversation in the news, and people have, applied for various student loans. I want everyone to know that regardless of what's going on or is being stated by the government, any student loan debt is going to be acknowledged on the credit report. You're either in an income-based repayment program, and there's any amount above 0 that I'm going to say your monthly liability is, or I'm taking 0.5% if you're in forbearance or deferment, and that amount says 0. So just know that 0 is never used in a mortgage pre-qualification. There has to be some acknowledgement for the federal debt that student loans are. If you have any questions, write those down and we can address those when I wrap up here. And then assets, we've been talking about that as well. Your options for those, paper trail, paper trail, paper trail. I think I've covered everything there. I do have some information to help with the down payment here. Mercantile Bank offers what's called extra credit program for what's considered LMI, which stands for low to moderate income borrowers, or if you purchase a home in the low to moderate income census tract, we will give $2,500 off your closing costs. This is not a loan. This is a credit to you, so it could cover the gap in those closing costs. Ask me for more information and we can look at your fitting in this program and how this can benefit you. The last thing I want to say in general, in an age of technology and scams, there is such a thing as called predatory lending. If it doesn't feel right, reach out for help. But predatory lending is any lending that imposes unfair or abusive loan terms on a borrower. It is also any practice that convinces a borrower to accept unfair terms through deceptive, coercive, exploitative, or unscrupulous actions for a loan that a borrower doesn't need, doesn't want, or can't afford. A mortgage is your choice. A mortgage is your right. A mortgage is something that needs your agreement to. So if you feel like you are in any predatory situation, please lift that up. It is a right, as it is a responsibility of a loan officer, if that has been lifted up, that we take action as an advocate in the housing industry. So just know that this is your journey and we are all here to support you on it. I'm going to share our extra credit program with you. I do have business cards and pens for you, and I am happy to take any questions that you may have written down or want to lift up at this time. Sure. I'm good. How are you?
I was just wondering, as far as a primary residence, secondary residence, and income property, how does that process go for somebody trying to, for example, a secondary residence? How did that go? What makes that not a income property?
Okay. Thank you for lifting that up. Primary residence is where you lay your head every night. The lowest down payment options are for where you're going to live, your primary residence. A secondary resident is a place that you may occupy for a time period of year. It does need to be a reasonable distance from your home to count as a secondary residence. For example, you can't buy two houses next door and say, I'm going to have this one here. The down payment is slightly higher than your primary residence, but a person can have multiple mortgages and one of them be their secondary mortgage. The third type of mortgage they can have is for an investment property that is an income producing property, and that down payment is the highest of all three because of that designation as an investment property.
Okay, so that secondary property, it's kind of like the same process as a primary. It'll be the same process, just with a little bit more down payment.
Correct. The pre-qualification, pre-approval process, they all have the same entry point. If it's a construction loan, you're doing a new build, I'm still assessing income, assets, and credit. And then based on that loan program's qualification, I have to fit you to those guidelines.
Okay.
They all do have the same starting process.
Okay. Can you walk me through a little bit about, okay, let's say I'm looking to buy a home and this home has equity in it. How I was hearing about how a person can access that existing equity and helping them purchase the property.
That typically only comes up if it's a transaction with someone you know and they're gifting that equity. But if it's a home on the market and someone's selling it, you may not be able to benefit that because they're going to want to benefit their own equity. But if it's your family member selling you the home and there's equity and they want to help you, we will assess the equity, which is the difference between the value of the home and what's owed on the home, and that could be a gift to you.
Okay, and one last one. Or no, I got two more questions. Sure. I'm sorry.
How
do I avoid the possibility of Like, let's say I got a friend who he has a mortgage, and then they told him he needed to come up with X amount of dollars because the taxes, the property taxes, they didn't add it up right, and so it was more, and so it ended up like doubling his mortgage. How do a person go about avoiding a situation like that when if I'm borrowing money from you and you telling me how much I need to give you, and then we do that transaction, and then 6 months down the line, if something changed because of, I'm looking at it like they mistake because y'all like, oh, we need more money than what we calculated. How does that fall on the homeowner when, like, thank God he was able to make the more of a monthly payment, but is so that's a thing?
Um, that's a tough question because I would need those specific details, but
Okay.
you stated property taxes, which are set by cities, and every time we have elections and we vote for millages, our property taxes could change, and the city will inform you of that in the bank because we're holding the escrow account. So unfortunately, that's something that we don't, as the mortgage financer, have any control over if it is specifically the taxes. Those other things are specific to fixed rate or adjustable rate, and anything that could happen financially with the mortgage specifically will be disclosed at the closing. So the rate, if it's fixed, can't change, but
Right.
if property taxes change, then yes, the borrower is responsible for that. And unfortunately, we cannot tell local government, no, we're
Right,
not
I
going to pay the
understand that,
taxes.
but to the point of literally doubled now, like if your
I would
mortgage,
need more details about that.
And when they close, their home that they're in, I noticed it when I was looking at comps, they didn't put the homestead tax credit on their house. So it looks like they own a house, or they're in a house, but it looks like they're taxing them like they don't own a home, right? Like they're a non-owner, like they're an investor. So instead of having 100% homestead, which would lower your taxes, they had 0% homestead. So they were paying probably about $3,000 more than they should because of that mistake. But it's correctable. So I advise them to go down to city Kentwood, actually Kentwood, to put that homestead on. Something got lost in the paperwork after they closed. Something didn't get filed properly. So I've seen it happen in that situation. But that's correctable.
okay. And one final question. With the USDA thing, does that just is that just for first time home buyers?
No, anyone that wants to purchase a rural development loan through USDA can apply for that.
And so you've been through that. You could help me with that if that's something I wanted
Yes.
to. Okay. That's it.
Yep. Any other questions? Jay?
Tanya will probably touch on this, but USDA or rural development, there's a map, and you can go online, or your realtor can go online and look at it. It's everything. USDA is going to be outside the city limits of Grand Rapids and kind of out in the country. That's what
you
RD
can't
is going to
use the rural development product if it is not designated as a rural property. All right. Thank you, everyone, for your time and attention today. I will be sharing some resources. Best wishes on your home ownership journey. You will have my contact information if you want to speak about your specific situation or get any further questions answered. Thank you.
Let's give Staci a round of applause. So before I talk about the process of buying a home, I want to give away some questions. I have a book called Your First Home, written by Gary Keller and Jay Powell-May. So who in the room expects to buy a home in 2023? Okay. Let's see. Who since there are several realtors in the room, some represent organization Roma that Jay talked about, and then also some of my team is here. So as I mentioned, I lead the Legacy Homes GR team at Keller-Williams. My team consists of 7 fabulous agents, and they're shown right here. You might have white coats. In the room with us today is Angelique Eckers, back of the room. In the far back of the room, Jesse Jones. And did I miss anybody else? So those are the folks who are here for my team today, but you may recognize my son Parker, who's my director of operation, Jason Griffin, Sonny Jordan, Stephanie Pierce. Those are people who have been on my team for a while. Also in the room, president of our local Roma chapter, Jay Kilgo. Vice president of our Roma chapter, Tunisia Adams. And you're going to kill me, son. Yeah. Katie, who works at Pinnacle with Jay. Any other real estate agents in the room? All right. So lots of great resources here in the room. So if you have questions after my presentation, feel free to connect with any of us. So the first thing I wanted to kind of tell you about the market, I feel really loud. The first thing I want to do is tell you about what's happening in the market. Right now, we're in what's called a seller's market. What that means is the inventory that's available right now really favors the seller. There's not enough. Usually there's in a balanced, healthy real estate market, there's about a 4 to 6 month supply of housing stock. So it would take 4 to 6 months generally for us to sell everything that we have. Because we're in a seller's market, there's less than 6 months of inventory available. And in fact, I just looked at the reports for October, we have 0.8%, 0.8 months of supply. That's less than a month of inventory, of housing inventory. So we could sell everything that we have available in less than a month. In 2019, that number was a 1.5. In 2022, it was 1.1 months of supply. So you can see that because of the limited amount of inventory that we have, it's to the advantage of someone who wants to sell their home. The second thing I wanted to tell you was prices, though, on the other hand, continue to, over the last, since COVID, so 2022 and 2021, the average U.S. home price was about $455,000. Here in West Michigan, that number today is closer to $340,000. That's the average price here in West Michigan. So that makes West Michigan, to those people who are investors, a pretty interesting market for them. And what we find is it makes the affordable housing very difficult for us because you're competing against investors coming in from other areas. If you're in that $200,000 price point or below, investors who are coming in from outside of the area, because Grand Rapids is a top 10 community in terms of growth, right? They're coming in and they're paying cash for those homes, which is making it very difficult for affordable homes. But one of the things I wanted to tell you, go back to the previous slide, Jesse. Our team was able to, in 2021, serve 91 families, and we shoot to serve about 100 families every year. So it's possible to get it done. It's about the relationships that we have with other agents, the ability to find homes off market, and things that we do to help our buyers to compete successfully. So This year, actually in 2022, we celebrated serving our 500 customers. So we're pretty proud of that. So it can be done, but it needs to be intentional and well planned. That means so making sure your credit score is where it needs to be, using somebody like Tiffany to make sure that you're in the best position with your credit score to get the best interest rate. Why does that matter? What is credit score? How does that impact credit score impact your interest rate based on what Staci told us? Anybody want to tell me? Remind me? Right? If your credit score is lower, you're going to be paying a higher interest rate, right? Which will impact your monthly house payment. So for example, I did a quick example. So if you were buying a $300,000 home and the interest rates were where they were a couple years ago, and we'll talk a little bit more about what's happening with interest rates, but couple years ago, they were in that 2 to 4% range. Today, they're more like 6.5% for a good credit score. On a $300,000 home, what that would mean is that your house payment, instead of being, I did 2.66%, the house payment would have been, with everything included, about $1,200 a month. But at 6.25%, it's more like $1,700. So that's a pretty big difference for a lot of us, right? So that, to me, stresses the importance of doing everything that you can do to get your credit score where it needs, so that when you do apply, you're getting the best rate. We don't want to pay more for the same house as our neighbor next door because our credit score was lower, right? We want to get that in order so that we're in the best position possible when we go out to shop for a house. So one thing I said is the seller's market. I said inventory is down. You're competing against a lot of other buyers because there's just not a lot of inventory. Most of the homes that we sell here in West Michigan are in that $200,000 to $400,000 price point. If you're below $200,000 price point, you're competing. So you have to be well prepared. So home prices, that's the other thing I wanted to talk about. I did talk about prices a little bit, but I wanted to dispel a couple myths. I've heard more than my fair share of times this year, we're going to have another crash. A crash is coming. Unfortunately, I got to tell you, it's very unlikely that we're going to have a crash. The difference between 2022 and 2008, when that happened before, is that lenders, and I'm not saying Mercantile, but other lenders were giving loans to anybody who could breathe, whether you could afford it or not. And they've tightened up the guidelines and regulations so that that's not happening today. So will there be people who will lose their homes? Of course, unfortunately, that will happen. But the market won't crash because of bad loans, right? That's not going to happen again. The other thing I was going to say is prices will likely flatten over the next few years. I've seen more price adjustments over the last couple of years than I've seen price reductions than I've seen in years, right? You see houses go on the market, and after a couple of weeks, you see the prices getting reduced. In 2020 and 2021, that was not happening at all, right? But buyers are getting a little more particular because of the higher interest rates. I'm not willing to pay $1,700 for that house anymore. So that's what we're seeing in the market. However, homeownership is still the best absolute way to build wealth for your children and your children's children, if that is your goal. I have clients who bought their home in 2020 or 2019, who for some reason or other, like one person was moving a family member or parent in with them, so they needed a bigger house. So they bought a house over in Bailey's Grove in 2019, and when they sold it 2 years later, they walked away with $100,000 more. How do you justify staying in an apartment or paying somebody else's mortgage, paying $1,200, $1,500, $1,800 a month when you can have that kind of money set aside for your children? Somebody could have went to college on that, right? So it's time for us to get our financial house in order so that we can work together to help more people become homeowners. That's what we're all about at 1,000 Families of Color. We're trying to help Black families, Hispanic families, brown families become homeowners. When you look at the statistics, back in 1968, I think it was, when the Civil Rights Act was passed, we were at like 44%, talking to Black families, we were at like 44% of us owned homes. Today, that number is like 42%. We're going backwards. You would think more of us would own homes now. We're not doing the things that we need to do financially to make that a priority, and that really needs to stop. It's all about educating our youth, like you said, so that they know and they don't make the same mistakes that we made. And it's never too late for us. Never too late for us. I have clients who have bankruptcies, foreclosures. It's possible to still own a home, right? You just have to wait a little while for your credit score to go back up and work on some things, but I've seen it done. So the last couple things I wanted to say before I answer questions, and I'm all off my slides. Can you go to the next one? I think I talked about that one. Yeah, I talked about what's happening in the market. The thing I wanted to point out, though, that when I talked about inventory, I'm looking at new listings for the month of October for this year. They're down 4.2%. So again, that stresses that we don't have the inventory that we've had before, but home prices are up about 14%. So between that, when I gave you that example between 2019 and 2021, we saw like a maybe 15 to 20% increase. Now we're at about a 14% increase. So it's going to continue home prices will continue to rise. So the next thing I wanted to do is talk about, if you're a seller, what are some things that you need to consider right now? So in your packet, there's a list of 47 things that you can do to prepare to sell your home. Today, I'm finding that people are deciding to sell their home because they're getting older, they can't do the stairs anymore, they're relocating to other areas. Those are the main reasons that I'm seeing people decide to sell today. They want a different school district, things like that. But I want to highlight just a couple of things on that list, speaking specifically to people who own their homes right now, who are considering selling. It is absolutely imperative that you remove clutter from the room so to make them more visually appealing. So when we come in with our professional photography services, we want kitchen countertops clear, bed, I know, those closets that are full to the brim, we want them thinned out, box up things you don't wear anymore, because a lot of us have things that we haven't worn in years. Like, we want it to look almost as if you don't live there, like that clean. That helps you to get the most amount of value for your home. Replacing carpet if it doesn't clean up well. Putting family photos in storage, and this is a pretty sensitive one for us. Over the last few years, we've had problems with African American families getting appraisals that are lower than we think they should be. But it's just something that I think most agents tell people to do. Put away your family photos. You'd hate to think it discourages people from buying your home, but we don't even want to make it an issue. So we have people put family photos away and things like that. And the last thing to do is staging your home. And you can go to the next slide. So there are some updates and repairs that we typically suggest for sellers. Painting, very easy, very affordable. Flooring, if your flooring is outdated, that brings value, as well as lighting. If you've got older fixtures, that's something that we want you to take care of. In terms of repairs, we also suggest if you know of a major issue, especially if it relates to electrical or plumbing or your roof, that you address those things before the inspection. The last thing we want to see is you get an offer, the person goes and starts the inspection, and then it fails because you didn't take care of those types of issues. So those are the things that we want. And then we also want to make sure that you, on the next slide, upgrade your landscaping. Curb appeal matters. And I talked about the hardwood floors, power washing that deck, things like that. So those are the things that we ask sellers to consider right now. The last part I want to talk about is because what you're here for is what to expect as a home buyer. So you can go to the next slide. So how home buying works. What we do initially, the first step you want to do, and this is in your packet, is to partner with an agent. Not just any agent, you want a great agent. Jay.
How much does it cost me to work with you? I heard Tanya's a good agent. I want to work with an agent, but how much is it going to cost me as a buyer to work with you?
My commission is paid by the seller, and every agent's commission is paid by the seller, but we have the opportunity to work with you, and our commissions vary. So some of us charge 6%, some of us charge 7%, but that's split between both agents. But on the buyer side, the seller takes care of that. What the buyer would expect, though, is most agents do charge a broker administration fee, and that varies by agent. So great question. So first, find a great agent, and the agents in the room, I need you to chime in on this, because there's this fallacy that we're all created equal, right? An agent is an agent. I found them on Zillow, so I'm going to use them. But what makes a great agent? Jump in, anybody. But how do you know what you're looking for if it's the first?
A great agent is an agent who's going to take the time to listen to your wants and your needs, because everybody's wants and needs are different. You know, you may tell me that you want a 3-bedroom home because you need a 3-bedroom home because you have 2 girls and 1 boy. And if I was a bad agent, would just be sending you 2-bedroom homes, and you'd be like, I just told her, you know, I wanted 3 bedrooms because not so much because you needed it. I mean, you wanted it, but you needed it. So a great agent is going to take the time and listen to your needs, wants, and also, I'm sorry, go ahead. Well, just another thing a good agent is going to do is sit down and talk with you. As for me, I can speak for myself and all the other agents that's in here. I'm going to sit down and say, what's your name? Nicole. I say, hey, Nicole, what are you looking for? You know, you're currently renting and you're in a 2-bedroom. How many kids do you have? I'm going to ask probing questions to get information from you so that I can say to you, okay, so you may say, oh, I have always had a dream to purchase a new home, to build a new home. So what I'm going to do is sit down and I'm going to tell you the beginning and the ends, the benefits and the negatives of buying or building. So by me giving you that information and me asking you those questions, I'm going to be able to find out what's your hot spots. And then also what I also do, along with some the Tanya's packet, I always ask, what is your dream list? You may say, I've always wanted a fenced in backyard. I have to have a finished basement because I have two rambunctious boys that I like to be in the basement. So you listen. That's what a good agent does, is listen to you. And you're going to tell me everything that you want, everything that you're looking for. And as a good agent, we're going to be able to give you the pros and the cons of being, maybe it's not time for you to do an investment property. Let's buy something first. And then I'm going to educate you on the process of all aspects of home ownership.
So the answer to that question was, a great agent listens and will help you to decipher between, they're going to first understand what you want, and then they're going to, your must-have list, and then they're going to understand what's on your nice-to-have list, and they're going to help you to figure it all out within your budget. Okay, Jay.
I also think take time to go online and look at reviews from that agent, see how they've helped other clients. So you can look up pretty much any agent online. But one of the things that I do with my clients is when we're walking through a home, I'm not a licensed inspector, but I'm walking through the home like I'm their brother or sister, or I'm family, and pointing out different things, because especially for first-time home buyers, they may not know to look up. To look in the corner. Let's see if there's any water damage. Let's look at the pipes in the basement. Okay, what's galvanized versus PVC? What's foundation supposed to look like? Different things that the average person may not know walking into a home. What are things that I need to keep an eye out or look for that is going to cost my client money down the road if they don't fix or if they don't keep updated? So I would say a good agent is one that's available first and foremost, that will sit down with you and talk to you about your wants and needs, but that also looks out for you throughout the whole process in buying a house.
Just to kind of add to that, it's a relationship. So someone that you can trust and talk to, and it's not just the transaction, it's educational. So they walk you through the beginning process, through the process, after the process, and beyond.
Proper expectations too. I feel like a lot of people don't know you can't check all your boxes in one house. So somebody has to let you know that sometimes it takes time. It's not going to be a quick process to find the house that you're looking for.
We're not looking for the perfect house either,
Right.
because it doesn't exist, and you wouldn't want to pay for it
Right.
today, because it's going to be very expensive. But those things that you must have within if it exists within your budget, a great agent will help you to find that, right? And a great agent will be honest with you to tell you what you want does not exist. But if you really want a house, these are the options. And is this okay? Or do we need to wait a little longer, right? So those are some things about a great agent. And let me tell you something. Most people only interview one agent before they start the process. I'm going to tell you to flip the script. Ask your friends. Who do they use? Did you like them? If they hated them, why would you go and use that same person, right? Ask for referrals. I love that, Jay. So you're going to partner with an agent. You're going to get pre-approved for a loan. You're going to call Staci. And then we're going to help you once you get pre-approved. We prefer that you're pre-approved versus pre-qualified, because there's nothing more hurtful I know it's hurtful to our clients, but hurtful to us if you get pre-qualified and we go out shopping and you find a home and then something wasn't exactly the way you told the lender and they can't get you closed.
Champagne taste and beer budget.
Yeah,
So you may I'm looking at everything that's costing $500,000, but then they tell me I only can approve for $250. And trust me, a $500,000 house and a $250 looks a lot different. And so then, if we start looking at those $500,000 houses and you only approve for the $250, you ain't gonna find nothing. Everything is gonna be like, oh, I hate this, I don't like this, because you're comparing it to that $500,000. So don't start looking before you know what you're working with. I mean, granted, it's good to window shop, have faith and believe, see the things that you like and you don't like. But trust me, when you're ready to start to buy, if you start looking for in the wrong budget price, when reality sets in, it's going to discourage you. Like, well, you know what? I'm just going to wait until I can afford that. That's not a good thing to do either. So always get pre-approved. Call Staci. She's always available, I'm sure, to get you pre-approved. So that's the first place you need to start. Besides talking to Tiffany, getting your credit together. If you know your credit is not together, but get that pre-approval, then you know what you're working with.
All right. So part of that process of finding a home is we've done our buyer consultation. I've sat down. I'm clear about what your wants are, what your needs are, what your timeline is, where you want to be. I'm clear about that. We got it in writing. All minds clear. That's what we're looking for. We're going to set up a portal where you can see the homes that are available within your criteria. So you'll get emails from us that show you homes that come on the market every day. And then we're going to go out and start looking. Personally, I set the expectation with my clients that we're probably going to find your home within the first 6 homes. That's my goal. If we have to look at more than 6, I'm probably not doing my job well. But the market is tough. So you do have to have some patience. I have clients last year who wrote a lot of offers. My team actually works with more buyers than I do, but we have buyers who wrote upwards of 12 offers last year and just could not compete, and weren't successful. So we had to go and find off-market opportunities or other opportunities, and we'll talk a little bit more about what it takes to compete. So after we find your home, you're going to work with your agent. They're going to make an offer and help you to negotiate the terms. That includes the price. That includes what you're going to put down. You should have known what you wanted to put down for down payment and earnest deposit. When we're going to close by, you're going to deliver the escrow check. That's the first time money comes out of your pocket as a buyer. And she talked a little bit about an EMD or an earnest deposit. What that typically is, it's typically about 1% of the purchase price. So if you're buying a $300,000 house, you're going to have at least a $3,000 earnest deposit. And that goes against the closing costs that you have to bring in the next 30 days when we actually sign all the documents and sign the home over to you. So we're going to make an offer. We're successful. Yay. The next thing, it goes to a status that's called under contract. That's when we schedule the home inspection. In the previous market, you would have 10 days to do your home inspection. In the current market, typically those get done within 3 to 5 business days. So we have inspectors on standby ready to do your inspection. That's the second time you come out of your money. You tip out of your pocket with money. You typically pay the inspector for doing your home inspection. They're inspecting the structure of the home, the plumbing, the mechanical, the electrical, all the major systems. They're looking at the roof to make sure that the house is in good shape. And what I tell my clients is that what we're looking for, because it opens up the contract to negotiation, we're looking for safety issues. We're looking for significant financial outlays, something that could cost you a lot of money down the road. Those are the things that we want to negotiate with the seller. If you got a light switch that's loose, then it's not a safety issue. That's what you put on your honey-do list or your list to do after you close, right? But we're looking for safety issues or significant financial outlays. There's also a lot of pressure in this market for people to waive inspections, which I rarely suggest that people do, unless you're going in a new construction.
Waive inspections, because this is probably the largest purchase that an average person makes in their lifetime. And you don't want to wake up the next morning and have your electrical go out and your house burns down because you failed to do inspection because all the bells and whistles were finished on that existing property. So,
Mhm.
so always think about that.
Right. Usually with new construction, they have a 1-year warranty, but like I said, I hardly ever suggest that anybody waive inspection. The next thing, once it's under contract, so you've done your inspection, the lender sends out that appraiser to do an appraisal, right? And they're different from the inspector. The appraiser is just going in, looking at the condition of the home. So when they go back and do their report for the bank, they can compare it to other homes that have sold in the neighborhood to make sure that that loan value that they're giving you makes sense, right? So one of the things I wanted to mention on appraisal, one of the things that our buyers are doing as well in this market is that they're having some reserve to be able to do an appraisal gap. When you look at the homes that have sold here in West Michigan, you'll see that in our statistics, homes are selling at about 104% of the list price typically. So that means they're selling over list price for the most part. So if you were a client of ours and there's a house we're looking at that's 300,000 and you're like, oh, I want to offer 250. I'm going to tell you, we're not doing it because we're not going to waste our time or your time. It's not the market for that. So prepare to pay. I mean, we'll look at comps, but typically in this market, you're not getting a discount right now because of the limited inventory. Anything else to say about that?
I did not mention in my presentation that the bank is not going to lend more than the value of the house. So based on that appraisal, we may have to make some adjustments. Sometimes borrowers think that they can borrow in excess of the value of the house for future repairs. And I just want to make it plain that once that appraisal report is returned, that is hopefully it matches or exceeds, then you have the opportunity to start with equity. But if the appraisal should come in lower, you cannot access more than the house is worth.
Mm-hmm. So typically what happens is we go back and we negotiate with the seller. Sometimes it's not always successful, but that's something that we've done in the past. But it's good for a buyer to have some money. We've had people have a $2,000, $5,000, $10,000 appraisal gap because they just wanted the house that bad. But thank God the values keep going up so high that we don't have the issue that they actually have to use it. But when they write their offer, they might write it in, oh, I got an extra $1,000 or $2,000. If that makes me have a better chance of winning it, put it in there and I'll take my chances. That's somebody who has cash reserves, right? So once it's under contract, inspection's done, appraisal's done, we're doing a lot of things behind the scenes for you. Stay in communication with your agent during that time. You're going to be spending a lot of time with that lender. Actually, you're going to get tired of the lender. You're like, they're picking on me. They keep asking me for stuff. But that's what they do. They want paper trail, paper trail, paper trail. Document everything. They're going to look at check stubs, tax returns, all that stuff she said. You're getting a gift. Okay, where'd it come from? Show me their bank statement. Show me that they had that money in their account, not under their mattress. Now, that doesn't work. Yes, it needs to be seasoned, is what they called it. Put it in the bank, let it season for a couple months, okay? And then the last part is once you get through all that documentation, we can schedule the closing. And what you need to do is have a government issue ID and come to closing. And then you'll take that money out of your account and bring it to closing in certified funds and sign your life away, not in a good way. Sign a lot of papers, and then typically this thing says you get your keys. Typically in this market, what we see, if the home is vacant, you'll get your keys at closing. But if someone lives in the house, what's typical in our market is that you give them 30 days to vacate. So that's what typically happens. So that is basically what I wanted to tell you about the process. What did I forget, agents in the room? Check your emails? Every day, okay. Okay. What else did I forget? So the best buyers for us know where their credit scores are, and hopefully it's a 640 or higher. She can approve a 580, but you're going to pay a higher interest rate. I would say 640 or higher, 700 or higher if you can, because what we found a couple years ago when it was super competitive is that if your credit was scoring, you could only get an FHA approval. And it's not a bad thing to get an FHA approval, but you were competing against other people who had conventional financing. And when, as a listing agent, and I take a lot of listings, when I see somebody with a conventional approval, that means they have good credit score and they have assets. So that makes them a stronger buyer on paper. So that's what you want to do. First, Staci, then Ms. Kroon.
I want to add, this is true both for lenders and realtors. The mortgage process, it can be time sensitive. So it's important to communicate with your family, your employer, whoever you have obligations to, that, as she said, check your email so you can respond in a timely fashion. Be available to go to listings. Make time every day to stay engaged in the process, because we have to move. We have a lot of parties involved. There's the sellers, the appraisers. So just know that time sensitivity is important, and you want to be aware and able to committed to the process until completion, and don't waste time or squander the time, because it can affect the transaction and the outcome of the transaction.
I'm thinking about, what if you had an unscrupulous agent? Like you have a good body of people there, and I think they all look like, and most of them I know are good agents. What if there was an unscrupulous agent? He just promised all this stuff, and then it turned out that now they put the buyer in a bind. What happens then? Excuse me? Yeah, but by
You
this
can
time,
always fire your agent, but that's the risk that you take. So when making a decision on your agent, don't just willy-nilly say, I'm going to work with it. You have the right to interview as many agents as you want to make sure that you're making a good
so if you have finalized the deal and found out that what went wrong is on the part of your agent, all you can do is just ho-hum it?
We have what's called errors and omissions insurance
Okay.
at our brokerage, that if something was not right, and we all operate under the same professional standards. If they're not operating professionally, we all have a local real estate board that we're responsible to.
Okay.
So you could file a complaint or something like that. But that's why it's important. You want to make sure that you have.
Question becomes because I ran into this about a week ago. This particular agent is doing business in their license in Michigan, but they have chosen not to be part of our local board. In my mind, it's like, okay, where's your integrity? So, always keep that in mind and find out if they are, fully licensed and they're part of our local board. That kind of shows you their integrity as well.
Mm-hmm. But ask for referrals and references, Jay.
Well, I'm surprised no one hit on this, and you might have said something about it, Staci, but don't make big changes when you're in the process that Tanya just talked about. Thank you, Lord. You sent us our house. We got the right house. Tanya said our offer is accepted. She says we're going to close in about 30 days. Oh, girl, let's go shopping for some furniture. Let's go. You get that the new refrigerator and dishwasher. The best time to do all of that is the day that you close, after you close.
After you
That is the best day to go shopping for the things for your new house, because everyone, you got a new house, you want new stuff in it. Please, please, please don't make changes to your credit, open up any store cards, or go make big purchases before you close on that house. And it doesn't happen that often, but it happens. And it's happened to me. I've had clients, they were approved, but then they made changes and they went and bought stuff and they became unapproved and they lost out on the house that they wanted to. So that's a really big one to keep in mind.
Yes. Also, I'll say with that, Jay, don't quit your job. I've had people do that in the process. Like, what? They're going to verify your employment. You quit your job and you still think we get in this house? No, they're
Exactly.
not. It's not going to happen.
When he said big purchases, that even includes a car. I had a client where their car broke down, and I remember my daughter coming in and said, "Mom, so-and-so then bought a new van." I'm like, "Yeah, no, they didn't." And they did. And the loan officer told them, you were not approved. Do you know these people showed up to my office like, okay. And I'm like, what are they here for? They thought we was about to close. And I'm thinking, yeah, the loan officer had already told them, but they, in their mind, they're like, all we did is bought another car. We needed that. So that makes a difference too. It's not just your furniture or whatever, anything. You just ride it out until after you sign on that dotted line, okay? Because trust me, as soon as you close on that house, everybody gonna want to give you some credit. Home Depot, car places, Lowe's, everybody's gonna want to give you a new car or whatever that may be. So just tell them, just hold tight.
Very good. What questions do you all have for me? I was thorough.
How does somebody become a realtor?
Thank you. That is something I mentioned. I'm part of 1,000 Families of Color. One of the things that we're trying to do is we're helping people to build wealth by educating this way, doing financial literacy, helping people to become homeowners. But more than that, we want people to get into real estate as a career. We have I love my team. We have people that are independent agents. That means they're not on a team, but we need more representation within real estate. It's a great career. If you like to talk to people, you don't mind talking to people, you like looking at houses, that's what I hear most often. You have to have some hustle about yourself because it's a commission job. There's no paycheck unless you go out and slay something, right? But it's a very lucrative career. I have an agent who made 6 figures. He works another job and he still makes 6 figures, right? Doing real estate. So it's possible. You can sell real estate. And you know a lot of people too. Oh my gosh, please get your license.
And not only that, Tanya, but there's also related careers, right?
Yeah.
Because we need more representation in appraisals.
Right.
We don't have very many Black appraisers in
Right.
West Michigan. You can become a mortgage loan officer, and we have other people in our organizations, 1,000 Families of Color and Roma, where different professionals of color, insurance, mortgage, real estate agents, appraisers, inspectors, that you can talk to if you're interested in becoming or starting in one of those fields.
Yes.
And we're all open to talk to you too,
Absolutely.
like about how to become a real estate agent.
Absolutely. So I have candles up here as gifts for those of you who have come who like candles. I have some candles up here and my 2023 calendar magnets. I think I put them in most of the folders, but if you didn't get one, I have some more up here. But I'd love to talk to you, or we would love to talk to you all, but so feel free to come up and ask any additional questions that you had. We will be in touch with you just to follow up to see what you thought of the workshop. And next time we have something, thank you, Jesse. The next thing we're going to have, Staci mentioned, is a pre-qualification day. So in January, you want to see where you are. We'll be at Home Repair Services on January 12th from 4 to 7 p.m. We have these 5 great lenders who are going to be there, and they're all going to be ready to say yes and to figure out how to help people to get into homes. So if you know of people who want to become homeowners, have them come to our event. We'll post it on our Legacy website, on the Thousand Families or Facebook page, on the Roma Facebook page. We'll send that flyer out to you if you included your email on the sign-in sheet, so that you can show up and we'll figure out how to get the process started for you. So let's give our other presenters a great round of applause. And I thank you and appreciate you all for your time today. Have a wonderful day. Have a wonderful weekend. Right up front. Oh, I know.